Everyone's stuck at home. No one can go out partying for any birthday, wedding, or baby showers. No one can go out to any class or any job meeting. And there is where Zoom comes and delivers happiness and also changes how people interact during this new culture of social distancing. Now, is Zoom a very good company to invest right now? Hello guys, this is Adriana Gorrin and welcome to another video. If you're new to my channel, I would really appreciate if you go and subscribe, smash the like button for the YouTube algorithm, and follow me on my Instagram. So in today's video, we're going to be talking about this company that is being booming lately. I'm gonna explain how does Zoom makes money, what services they offer, how they've been doing, and if it's a good company to buy or not at the moment and why. Zoom is a company that went public last year, and at the moment that they hit the market, they converted into the most valuable tech IPO at the moment because investors like what the company was doing. The stock has risen 137% in the last 3 months, and right now, at the time I'm recording this video, is sitting in a 65% growth from December of last year. It converted into the most popular free app in the Apple Store. Their daily users grew from 10 million users on December of 2019 to 200 million users of March of 2020. And yes, all this might sound incredible. A very good company that its growth is being crazy and looks like a good company to invest right now. But what do they do exactly? How are they making money? They are basically a platform that offers different services such as Zoom Meeting, Zoom Phone, Zoom Rooms, and many others. They are all about keeping their current customers and be able to reach new customers and innovate their platform. But how do they make money? Easy. From the sales of subscriptions to their platform, where they have a free option which has turned into the go-to platform for everything right now. University classes, fitness classes, family meetings, birthdays, weddings, partying, and everything else. But if you would like to improve your experience in this platform, you can pay between $14 to $20, which means that any decline in the demand for this platform will harm their business really hard. The biggest problem that they're facing right now is a security problem. Every day there is a new security or privacy issue. Soon after a security problem was disclosed that could allow attackers to steal Windows passwords, another researcher has identified 2 issues that can be used to take over a Zoom user's Mac and microphone and webcam, according to TechCrunch. The 2 bugs found by security researcher Patrick Wardle can be used by a local attacker able to gain physical control of a vulnerable Mac. By exploiting the bugs, the adversary can gain access to your computer and install malware or spyware. And also, they were able to find out that there were hackers posting verified Zoom accounts in the dark web. This type of security issues has made a lot of big companies prohibit the issues of their platform. For example, SpaceX, Elon Musk's company, banned employees from using the Zoom app, since it has significant privacy and security concerns. And I'm sure that SpaceX is not the only one. Also, Zoom is not the only company in this video and business solution industry, and is a very highly competitive market. Their biggest competitors from web-based meetings are Cisco, Webex, Skype, Google Hangout, and FaceTime. And then from the business solution side, there is Microsoft Teams, GoToMeeting, Cisco, and other platforms. But why is Zoom getting bigger than others and be able to gain market share at a really high rate? It can be because they are a very friendly and free platform, or maybe because of their marketing, or maybe it's because they allow 100 participants in the same call for free. Zoom has a market cap of $31.54 billion. Their market cap at the moment is more than the 3 biggest US airlines combined, which in my opinion is very, very crazy. They have a PE ratio of 1,255.86, which is insane and a big red flag for me unless they are already pricing a really big explosion. If we see the revenue growth, it's being crazy, almost doubling every year. So this is a growth company, and normally growth companies are valued higher than normal. Last year, they had a revenue of $622.66 million. and a net income of $25.31 million. Okay, so let's do some calculations in here. Analysts are expecting Zoom to have earnings per share of 0.43 cents, and they have a total of shares outstanding of 111.8 million shares. So if we multiply the total of shares outstanding of 111,800,000 shares times the 43 cents that analysts are expecting for their earnings per share, that would give us $48,074,000 in expected earnings for next year, which is a growth of almost 90% in earnings in comparison of last year, 2019. This company is expected to report earnings of $48,074,000 in this year, 2020. If we divide their current market valuation, which is $31,550,000,000, divided by the project earnings of $48,074,000, that would give us $656.28. This means that if they really have what is expected for earnings this year, they will still have a PE ratio of 656, which again, it's insane. Normally, a company with a high PE, like Amazon, for example, means that there are companies that investors see them as a really big and growing company. But Amazon is being able to demonstrate that their growth is solid and exponential. But now, let me explain you what this PE means. This means that if you were going to buy yourself alone, the whole company right now at a valuation of $31.54 billion, it will take you 656 years at an earnings of $48 million to get your money back. And for me, that sounds really crazy and not a very solid investment at all. We see here that yes, they had a revenue of $622.66 million, but it cost them $496.57 million to be able to generate that revenue. And the cost of their product is $135.4 million. Yes, they have a good balance sheet and are a cash machine. They have a total of assets of $1.29 billion, which is a growth of 263% from last year, as their cash increased from $176 million to $885 million in 1 year, and have a total liability of $455.9 million, leaving us with a total equity of $833.94 million. Analysts are expecting a 49.3% growth in their revenue for this year 2020 and 34.20% growth for next year 2021. Now, a very big concern at the moment is what will happen after this situation and people go back to their normal life. Zoom explained that they hope that the positive experience during this time make a lot of businesses and schools keep using this method or adopt any other Zoom service, since they were able to unify people during quarantine and leave a mark during these hard times. In my opinion, this company is incredible overvalued at the moment. Yes, their service is incredible, everyone is using it at the moment, but I just don't like their valuation and don't recommend anyone to invest in it, since there is nothing to justify the current valuation. But I'm not able to control anyone's money. So also remember that I'm not a financial advisor. Always do your due diligence before investing in anything, not only the stock market. This is only for entertainment purposes. Let me know in the comment section below if you agree with me or not, and if you own any Zoom stock. If you like this type of stock analysis videos, go and check my last videos analysis in my channel on any other stock. Thank you for watching this video. If you enjoy it, I will ask you to smash the like button for the YouTube algorithm, subscribe, and follow me on my Instagram. Thank you and see you next time.